second component is a financial asset which is an equity investment. Now, when it is equity instrument, they are never measured at amortized cost. If they are never measured at amortized cost, what will be the valuation? Equity instruments are measured at fair value through P&L. Now, when they are measured at fair value through P&L, they'll be remeasured at the end of each year. Any gain or loss will be directly taken to P&L at the end of each year. But what if you plan to hold this investment for a longer period of time? Your P&L will get hit with the gain or loss at the end of each year, but you plan to hold this investment for a longer period of time. Would you like that your P&L gets deteriorated or gets increased? Every year there is a component which is impacting the P&L at the end of each year because of this remeasurement of this equity instrument, which you plan to hold it for a longer period of time. If it is held for trading, then there is no problem because you want to hold it for trading, and if there is any gain or loss which is taken to P&L, it is justified. But what if you plan to hold it for a longer period of time and you do not intend the P&L to get hit at the end of each year? What is the way out? What is the way out? If you have made an investment in an entity in their equity instruments and it is a very volatile instrument, you're not holding it for trading because you're believing that in the long run you'll be benefited out of it. You plan to hold it for a longer period of time, but because of the accounting of equity instruments under IFRS 9, you have to remeasure it at the end of each year and you have to take the difference to P&L. Your P&L is being hit at the end of each year, but you're not liking this. Since your intention is to hold it for a longer period, you do not want the volatility to be shown as part of your P&L. What is the way out? Fair value through OCI? Now, is it normally allowed or is it a special designation? So there is an option. There is an irrevocable option. Irrevocable option to designate equity instruments at fair value through OCI. When I say irrevocable option, means you do not have any chance to measure them at fair value through P&L even in future if you opt for this designation. And if you opt for this designation, these equity instruments will be measured at fair value through OCI. On settlement, because you have intention to sell, on settlement, or if you sell them in future, the fair value through OCI reserve is directly transferred to retained earnings, never reclassified to P&L. Irrevocable means cannot go back to the category of fair value through P&L. If you designated it as a fair value through OCI item, this will be forming part of a separate component of equity instrument designated at fair value through OCI. Any remeasurement will be shown as part of other component of equity routed through fair value through OCI. And even on settlement, this will never be reclassified to P&L. This is one of the items which will never be reclassified to P&L. If you remember the items of other comprehensive income, there were 3 items which are never reclassified to P&L. One was unrecognized actual gains and losses, one was revaluation surplus, and this was the third item which is never reclassified to P&L. Equity instruments designated at fair value through OCI. Hope this is clear. So this is how we deal with financial assets, 2 categories. Financial assets, 2 categories, debt instrument as well as equity instrument. Now, do you wish to classify the debt instruments which are measured at amortized cost at fair value, or the debt instruments which are measured at fair value through OCI also at fair value? The third category is already at fair value through P&L, so there is no chance of changing it. But do you intend to record them also at fair value? Do you wish? The management is of the view that we want to give fairer presentation and we want to fair value the debt instruments which are measured at amortized cost, or the debt instruments which are measured at fair value through OCI. We intend to show them at fair value through P&L. Can you do so? On top of this, there is an irrevocable option. If you intend to do so or get into this arena, if you wish, there is an irrevocable option available. But that is irrevocable. If you do so, you cannot go back. Irrevocable option to measure at fair value through P&L for amortized cost balances, irrevocable option for fair value through OCI items as well. The third is already at fair value through P&L. So this is a top up which is available under IFRS 9 financial instruments, that if you still wish to record them for the purpose of fair presentation, if you still believe that this is not the manner of presentation you wish, you want to record it at fair value through P&L, you have an irrevocable option to do so. Hope this is clear. Yes, Akash, Ind AS is same as Ind AS 109 is same as IFRS 9 now. This is how we deal with financial assets. Is the financial assets part clear? And also the intent behind it. Financial assets divided into two parts: debt instruments, equity instruments. Debt instruments, three categories: amortized cost, fair value through OCI, fair value through P&L. Debt instruments never at amortized cost, normally measured at fair value through P&L. But if you wish to designate equity instruments which you intend to hold for a longer period of time, you have an option to designate them at fair value through OCI, but they are never reclassified to P&L, directly dealt with in retained earnings. Financial liabilities. Normally they are at amortized cost if contractual cash flows, payments of principal and interest. But if you are holding them for trading, they are measured at fair value through P&L. Now, do you have an option here as well to designate the amortized cost values at fair value through P&L? Here again, there is an option available. Designate irrevocable option to designate at fair value through P&L. Now, if you opt for this irrevocable option, so financial liabilities part is simple, that they are either at amortized cost or either at fair value through P&L. Now, when we are dealing with amortized cost balances, whether on financial assets or financial liabilities, the interest income on financial assets or interest expense on financial liabilities is calculated on the basis of effective interest rate. The effective interest rate is the rate. Effective interest rate is the rate which exactly discounts the net present value to 0. Now, what does it mean? Before I move on to this, let me talk about the transaction cost. Now, when we are issuing it, when the entity is issuing a debt, or an equity instrument, where they should record the transaction cost. In case of a financial asset, they are measured at amortized cost, and if there is a transaction cost relating to it, how to deal with it. If there is a financial liability, they are also measured at, if they are measured at amortized cost and there is a transaction cost relating to it. Issue of equity instruments, they are measured at fair value through P&L. What about the issue cost relating to them? Where to deal? And this is one area which creates confusion while you're dealing with the questions relating to financial instruments. How to deal with them? Now, if there is a financial asset, the transaction cost gets added to the carrying amount of asset. And if when we are borrowing funds and if we have incurred any transaction cost, that reduces the amount we have received. Reduces the carrying amount. And any issue costs are directly charged to equity. And if there is any financial instrument which is measured at fair value through P&L, and if there is any transaction cost, financial instruments measured at fair value through P&L, the transaction costs are expensed to P&L. Now, this has an impact. This addition to financial asset and reduction in the carrying amount of a liability has an impact on effective interest rate. What does it mean? It means that if an entity has borrowed 500,000, the transaction costs are 20,000. Effectively, how much amount they've received? How much amount is received by the entity? Is actually 4,80,000 only. But the coupon rate on this loan note may be 10%, which means that the payments at the end of each year will be 50,000. So when we compare that we've received 480,000 today, if we compare how much we are making payments in future, There will be payment of 50,000 at the end of each year. And suppose this is a 5-year loan note. Coupon rate on a 5-year loan note. 5-year 10% loan note. It seems that the rate of interest is 10%, but effectively the rate of interest is different because we need to take into account all the transaction costs and effectively what is the interest being borne by the entity. So the payment at the end of third year is 50,000. At the end of fourth year is 50,000. At the end of fifth year, we also need to repay the principal repayment. So there is a 10% loan note for a sum of 500,000. In the final year, the repayment will be minus 550,000. Now we have received 480 today, but we are making payments over a period of 5 years. What is the present value of all these payments today? What is the present value of all the payments today? At what rate shall we discount that the present value of all the payments we are making over a period of 5 years equals to 480,000 today, resulting in net present value to be 0. Means that if we have received 480,000 today, and if you're making these payments over a period of 5 years, at what rate shall we discount? So we use a technique known as IRR to know the rate at which we are able to discount. So if we discount all these payments of 50,000 at the rate of 11%, we'll get exactly 480,000 will be directly compared with net present value equivalent to 480,000 today, resulting in net present value to be 0. That we have received 480 and we are making payment of 480 over a period of time. So the rate at which we are making these payments is turning out to be 11%. This rate is effective interest rate. The rate which exactly discounts the net present value to 0 is known as effective interest rate. Effective interest rate is the rate we'll use to charge interest expense in profit or loss account at the end of each year. Did you get the concept of EIR, effective interest rate calculation? You will not be required to calculate EIR in the examination. You will be given a rate. Even if you are by chance asked to do so, because that is the financial management question, that how to use the technique of IRR to arrive at the rate. The rate for discounting is 1 upon 1 plus R raised to power n. This is also you will be required to use in rare circumstances because you will be given the discounting factors. So in the examination, you'll be given the annuity table and the present value factors. You can use directly referring to those tables to discount if required, or the effective interest rate will be provided to you. Hope this is clear. Or do you want me to also go through the trial and error of effective interest rate? Or I believe I should not do it in a accounting session. Should not get into the financial management part, how to use internal rate of return to calculate effective interest rate. Hope it is clear. Akash, Bhanu, Birpal, Hema, Manoj, Nitika, Pankaj, Prachi, Sapna. So the coupon rate is not the rate which we charge to P&L. It is actually the effective interest rate. That's the requirement of IFRS 9 financial instrument, that anything measured at amortized cost will record the interest at effective interest rate, will charge expense at the rate of effective interest rate. And effective interest rate is the rate which exactly discounts the net present value of all the payments we are making over a period of time in comparison to today equals to 0. That if I discount this 50,000, 50,000, 50,000 and 5,50,000, if I discount them at the rate of 11.085%, the net present value of all these payments today will turn out to be equivalent to 4,80,000, resulting in a net present value of 0. The rate which exactly discounts the net present value to 0 is 11.085% is the effective interest rate for the year. This is how we deal with financial assets and financial liabilities.
So in this scenario, we are going to amortize this transaction cost of say 20,000 over the life of the deal.
So we are going to, so this will be the opening balance for us. The effective interest rate applicable will be this into this rate of payment opening balance, effective interest rate, payment, amortized cost balance. Payment is 50,000. This is constant for all the years, 3, 4, and 5th year we are making a payment of 550,000. The amortized cost balance at the end of the year is 480,000 plus interest component and the payment. This is the closing amortized cost balance at the end of the year. So this exactly discounts the net present value to 0. The liability shown in our books opening will be 480, but it will be settled over a period of time to 0 because the rate at which we are charging interest in P&L is the rate which exactly discounts the net present value to 0 over a period of time. Our liability gets settled equally. So this is known as amortized cost balance, which will be shown in liability at the end of each year. Liability balance at the end of year 1 will be 483 and liability balance at the end of 5th year will be 0. This is only possible when we have taken the effective interest rate. Is this clear, Bhanu?
Yeah.
This is how the movement will take place. for dealing with the amortized cost balance of liability. This is solely payments of principal and interest, contractually agreed cash flow. We can predict them, and the only thing we need to remember is that we need to charge interest at effective interest rate, keeping in mind any transaction cost or any other cost which reduces the amount received by us. So effectively, interest is not applicable on $500,000. It is applicable on 480,000. So our liability begins from 480,000 and gets settled over a period of 5 years. Now, derivatives are any options, futures or forwards, futures contracts, forwards, options or interest swaps. They will either result in a financial asset or financial liabilities. Whatever is the situation at the end of each year, we'll measure them at fair value through P&L, take the difference to P&L. We may encounter an embedded derivative, which is a combination of a host contract and a derivative. Now, if the host contract is also a financial instrument, we can treat the entire contract according to IFRS 9 at fair value. But if there is no relationship between the host contract and derivative, host contract can be lease agreement, can be sales agreement. In that sense, the host contract will be dealt with under IFRS 16 and derivative component will be dealt with under IFRS 9, fair value through P&L. So we need to treat them separately, but if you are not able to bifurcate it, then we can treat it as one under IFRS 9 at fair value through P&L. But if there is no way they are related or interrelated, but only the arrangement is related, that it is dependent on some derivative, the host contract has a clause which has a derivative inherent in it, the occurrence or non-occurrence of future event will result in some financial asset or financial liability, then derivative component will treat under financial instruments. As far as treatment of impairment is concerned, I've already discussed with you the ECL model. Hope this is clear with everyone. After ECL model, we are left with hedge accounting. Any doubts till now? Anyone having any doubt till now? Any questions? With hedge accounting will be a totally different understanding of financial instruments, only if you wish to apply it. So let me clarify anything which still requires any clarification, so I can comment on that before I move on. Just give me a confirmation.
Amit, about this embedded derivatives where we have this host contract and derivative,
Yeah.
can you maybe explain just one example? I mean, not in maybe numbers, but just one example for better clarity.
The example for embedded derivatives means that the derivative is linked to a host contract. Like one example was leasing arrangement linked with the derivative, that further payments are linked to an index, or a construction contract measured in a foreign currency. Now the change in foreign currency is a derivative, and construction contract is not a derivative. So this is calculated as per the requirements of IFRS 15 revenue from contracts with customers. So what is amount due or from customer? But if there is any change in foreign currency which will result in some gain or loss, to be measured at fair value through P&L. Derivatives are treated directly into profit and loss account. If you are not able to bifurcate between a host and a derivative, and if you are able to reliably measure it, then we take the entire difference to P&L, fair value through P&L at the end of each year. If you are able to bifurcate, then life becomes easier. The derivative is directly treated in P&L. Any difference between the derivative. Now, derivative may result in an asset, may result in a liability. It is not fixed. It depends on the situation at the end of each reporting date. The host contract can be measured on the basis of the standard which is applicable if it is a non-derivative. Leasing arrangement, revenue arrangement, construction contract, insurance contract, or a debt or equity instrument, that is a bond having a relationship with the derivative, debenture having a relationship with the derivative. The host contract will be treated separately if bifurcated, and derivative separately. Let's move on to hedge accounting now. If anyone still has any doubt, please ask.
Amit, sorry for one more question, but there is also something called as this business model, right? What is that relating to?
What I discussed with you is the business model actually.
Okay.
That if your
Is it about the?
if your
Is it
business
about
model,
designation?
that's what your intention or business model is. That if your intention or mainly your business model is to solely receive payments of principal interest, you are a less risky investor. So business model is the risk appetite of the business.
Okay. Okay.
That your business model is dealing in debt instruments or equity instruments, then definitely the third gets applicable to you. But if your business model is to make investments which are solely payments of principal interest, your business model is amortized cost model.
Okay.
Your business model is to receive contractually agreed cash flows, but you also trade in them. You also sell them sometimes. Then it is fair value through OCI. There can be a change in the business model only if the underlying circumstances change. Not one or two. You can have both. You can have major of your dealings at amortized cost and some of the dealings at fair value through P&L. So in that sense, your business model will be SPPI and contractual agreed cash flow. All the transactions you do not have to do in one model. That's not necessary. But the business model on the face of the balance sheet or communication to shareholders is that what is the risk appetite of the business. If your business model is amortized cost model, then definitely you are a less risky investor. You do not indulge into risk relating to market. So the shareholder is aware that if I'm investing in this company, they do not play with my money. But if your business model is to trade, then the shareholder is aware that if they are investing in this company, they are trading into debt instruments or they're trading into equity instruments. It is subject to high risk. So the disclosure of business model is important for the decision making of shareholders. And if the circumstances change, you cannot change the model as per your choice. It's your status. It's the status of the business that this is the business model which is disclosed to the shareholders. You cannot change it by choice that my business model is fair value. It is about the transactions you have done. On the basis of that, the business model is disclosed. A business model can change. If the business model changes, you want to change it from amortized cost to fair value, then you can shift from amortized cost model to fair value, that fair value through that you intend to trade now. You do not intend to hold for contractually related cash flows. You were trading till now, but you intend to hold it till maturity. Your model changes from FVTPL to amortized cost. So this intention which we discussed is actually the business model of the entity. Yeah.
Yeah, I mean, clear. I just thought that it is something else, but yes, I mean, in this context, yeah, it is.
I made it simple because if we go through the contents of financial instrument in the book, I think we'll not be able to know where to begin and where to end.
Yes.
Okay. So I have summarized it for your benefit so that you understand it in very simple terms. Got it?
Yeah, I mean, it's clear.
So reclassification is not permitted for liabilities. Reclassification is not permitted simply because your intention has changed, or there is a temporary disappearance of the financial instruments you have dealt with have disappeared. So reclassification of financial liabilities, reclassification of equity instrument is not permitted. Reclassification is permitted for change in business model only for debt instruments.
Amit, just
Yes.
have a question in mind. I think it may deviate from the context here. I'm just thinking that what is the requirement of having embedded derivatives? And what are such scenarios? As in the book, I can see that or equity instruments, contract, sale purchase contract. But how? What makes it necessary for having embedded derivatives in any scenario?
It is in cases when we try to link it with the performance in the market. Like the insurance contracts, if you notice, nowadays there are insurance companies are selling SIPs along with the insurance. That they are saying that whatever payment you are making to us is secured. You are not only making the payment for your insurance, but we will invest it into some blue chip companies and you'll also get a return to it. And they link it with the market. So whatever is the NAV or the value you get is not based on amortized cost or the contractual cash flows. There is a link with the market as well. Now, if the entire contract is linked with the market, then we measure the entire contract at fair value through P&L. But if we can bifurcate it into two components, that one is derivative, one is subject to market risk, and one is measurable on the basis of the standard which is applicable. Now, if there is a construction contract which is linked with the foreign currency, which is automatically turning out to be an embedded contract. So we intentionally didn't get into it, but because of the substance of the transaction, we got into this remeasurement of foreign currency because we are required to do so even under IS 2021, effects of changes in foreign exchange rates. We have to take the exchange differences to P&L. And if it is resulting in an asset or liability because of change in fluctuation, now financial instrument says that it results in an asset of one entity and liability of another entity. Now, if that construction contract has a derivative element in it, which may result in gain or loss for us and which may also result in a financial asset or financial liability. Derivative automatically means that a gain will result in a financial asset for us, a loss will result in a financial liability for us. So if we link any lease agreement or a bond arrangement or insurance contract or a sales agreement or a construction contract with the derivative, it becomes a hybrid or embedded derivative. If there was no link, it would have been a normal arrangement dealt with by that particular standard. But linking through it is resulting in any asset or liability at the end of each year. So it depends on the arrangement with the party. Have you taken any insurance which has a investment element in it?
I did in plain investments, not driven by.
So how will you measure that investment, that if there is a link with the market fluctuation, if we are not aware of the difference between embedded host contract and derivative component of it, we'll not be able to measure the performance of our investment. So it says that if you are able to bifurcate it, please bifurcate it and try to calculate your host contract separately as per the standard applicable on it, and embedded derivative separately, so that you know the derivative component of the embedded derivative separately, so you know the gain or loss on it, how it is going to fare in the market. So embedded derivative is a financial instrument which is combined with the non-derivative host contract, which results in making it a hybrid financial instrument. Like if you noticed here, we discussed about debt instruments, amortized first, fair value through P&L, equity instruments measured. But when it was the turn of derivative, it was simple. Derivative may result in an asset or liability. So I cannot strictly classify it into either financial asset or financial liability. It depends on some other underlying asset or index or a rate. So this is falling under both financial assets and financial liabilities. So a financial asset, which is a bond, may be linked to a derivative. Now, if this financial asset, which is a bond, if you are measuring it at fair value through P&L, derivatives are anyway being measured at fair value through P&L. You can record the entire hybrid contract, a bond which is measured at fair value through P&L, linked to a derivative which is anyway measured to fair value through P&L. You can measure the entire hybrid derivative contract at fair value through P&L. But if it is not a financial asset, or if it is not a financial instrument, if the embedded derivative doesn't have a financial instrument component as a non-derivative, if it is some other contract, because other contracts can be leasing contracts, can be your sales contracts, can be your construction contracts. If you by chance link them with some derivative, then you need to separate the host contract, deal it with that particular standard derivative according to IFRS 9 financial instruments. That's what it is trying to portray. Hope it is clear.